Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome in Christopher Whalen, chairman of Whalen Global Advisors, veteran investment banker, and the author of Inflated: Money, Debt, and the American Dream, now in its second edition. We discuss the US-China trade war and Trump's tariff policies, and how they will shape the global economy and markets. Is the situation as dire as many are proclaiming? We're going to get his thoughts on the current health of the US banking sector and whether he sees any systemic risks that could upend the whole system. We're going to dive into gold, silver, and find out which other commodities he thinks are presenting an opportunity right now, and so much more. I hope you'll enjoy today's conversation with Christopher Whalen. Christopher Whalen, great to have you on the program. I want to kick things off with a question I ask all first-time guests, and that is, what are the main themes and trends you're currently watching when it comes to the economy and financial markets that you think more investors should be paying attention to?
I think the big trend I have been following for a while, Jesse, is what's going on the commercial side of the equation. Unlike 2008, everybody has been waiting for a consumer recession really since last summer. Remember, we were going to cut interest rates in the third quarter, and it didn't happen. So all of the pain and suffering has largely been on the commercial real estate side. Multifamily real estate is another area that's a mess. But meanwhile, my banks, most of them were reporting down credit expenses again in the first quarter. In some cases, this goes back to the first quarter of last year. So the whole narrative that economists have been talking about, recession, everything else, has not materialized at all, at least not in the traditional sense. So I'm watching the consumer on the one hand. And then the other question really is the treasury market. What happens to interest rates? The short term is the Fed. And the rest of it is really the Treasury. Scott Bessent, the Treasury Secretary, has said that several times. Long-term interest rates are my problem. So those are really the two things I'm looking for, because if we don't have a recession, then that's going to change behavior a lot for corporations, consumers, everybody else.
When it comes to the consumer and the question of recession, we always hear this narrative being brought up that it was the pandemic stimulus money that has not yet been worked through, but it hasn't yet gone through the system, and that is why we're seeing strong consumer data. What are your thoughts there? Because it's been a while since then, but as we know, there's lagging effects when it comes to that sort of event, that sort of massive wealth creation event. How do you see that playing a role, if at all?
I think that the basic premise, which is that both the Fed and the Congress put an awful lot of money into the system during COVID and immediately after, is correct. Now, classical theory says that monetary policy should not spill over into stocks, but we know that's not true. And we know this because not only has the stock market been unable to absorb all of the liquidity, but we've seen this huge boom in private equity, commercial real estate, everything else, and that has tended to take an awful lot of the liquidity off the table, if you will, in terms of inflation and the economy. So the way I look at it is, yes, there was a lot of surplus liquidity. The way you follow this, by the way, is when the Fed has to start issuing reverse repurchase agreements, which are basically T-bills issued by the Fed. I often compare this to the movie Fantasia, the Wizard's Apprentice, Mickey Mouse, who has to sop up the excess water that's spilling onto the floor. Well, that's really what the Fed had to do. They put too much into the economy, and then they had to go soak it up because a bunch of money market funds and banks were going to go out of business. Interest rates were at zero, right? So, the ebb and flow of policy has actually been more of a source of volatility than the economy itself. So now I think what you're seeing is that the private sector particularly is doing better than all of the dim economists expected. People are holding on to jobs. They're doing a lot of other things that are really not following the dismal narrative of Wall Street. And you see this today. I mean, let's take a look. Yeah, tens are at 4.28 this morning. Everybody said, treasuries were going to go to 5%. It hasn't happened. In fact, the money's coming back. So it's a fascinating conflict between what people think is going to happen and what is actually happening.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver, Gold, Osmium. For all your precious metals needs, Ian Everard, owner of ARC, is one of the most honest and level-headed silver gold dealers in America who wants to make sure that you get the deal that's right for you. And the specials this week are Silver Kangaroos 2023, 1 ounce coins, $9,999, fine silver, mint fresh at only $2.47 over spot, and Silver Maple Leafs, 1 ounce, $9.99, fine silver, $2.87 over spot. Well, supplies last, so reach out to Ian today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Yeah, very interesting. I, of course, want to get to the Trump tariff fiasco, the aftermath of Liberation Day, this kind of what seems to be a new policy that is coming to the forefront. A lot of people are calling it a complete regime change when it comes to how the global economy works. What are the long-reaching implications of this policy? And how do you feel about the trade war that appears to be accelerating between the US and China? At the end of the day, it seems like China was the last man left in the crosshairs. You know, a 90-day pause is being put on. Supposedly, different countries are coming to the table and having discussions, and we could see some sort of agreements come to that could perhaps reduce or eliminate tariffs for a lot of other countries. So firstly, how do you feel about the potential long-term implications of these policies? And what are your thoughts on the US-China trade war that is brewing?
Look, Donald Trump is doing what other politicians should have done, which was recognize that the Bretton Woods Agreement and really 75 years of history that was built upon the idea of using the dollar as global money has pretty much run its course. If Donald Trump was not in the White House today, somebody else, I hope, would be having this conversation with Americans. Because what we discovered, and I talk about this a lot in my new book, is that it's not just a case where we have to run big external deficits to be the world's reserve currency, right? It also now is very clear that we have to have high internal inflation, which is why Donald Trump won the last election. There are a lot of Americans who can't shop at Walmart. Okay. And that fact, the drop in purchasing power of the dollar, and also the inability of the average worker to keep up with inflation in the U.S., created some very powerful political forces. Now, I think at the end of the day, the whole trade war that Donald Trump has begun is really about China. China is a modern mercantilist state that has all of the weapons of a totalitarian regime and also a very unbalanced economy. They basically want to run trade surpluses with everybody. You see this in their Belt and Road project around the world and in Africa and South America, where they go out and take advantage of small countries that cannot afford to pay them back. This is classic British mercantilism. And obviously the Chinese learned this from the British during the foreign occupation of China, which went on for more than 100 years. So I think that really at the end of the day, we're going to cut deals with all of the other countries. We're going to cut deals with India and China, or, Japan and Europe and the rest of them. China and a few other rogue states are going to be left. And that's where the real negotiations, I think, are going to take place. But, what is President Trump saying? He's saying we want an equal relationship with other nations of the world. We rebuilt the world after World War II. We've let you, drink our blood for 75 years and have the advantage of a relationship with the U.S. Now it's time to have a little bit more balance. And what that means is that the dollar over the next couple of decades, I think, is going to slowly decline as the predominant currency. It will not ever be forced out because it's so big. Think about it. Where else would you go if you want to trade oil? If you're going to trade oil, you have to settle in dollars. The euro and the yen are potential alternatives, but do they want to import all the inflation that comes along with being a reserve currency? No. If you think about it, why was the dollar so strong last year? Because of our great fundamentals? Because of our budget deficit? No. It was, popular because it's big. People can not only do trade transactions in dollars, but they can do huge investment transactions. The Chinese borrow in dollars, and they use the swap markets very effectively. So that's why people like dollars. It's free. They don't have to pay for it. In most of the world, remember, if you go around South America, around Asia, many of these economies are dollarized. They index their wages in dollars for professionals. Real estate transactions are in dollars. So it's tough to change this. People get the job of the reserve currency usually after a war. And, I talk about that a great deal in my book. So
some fascinating information there. Are you watching the Chinese economy, and what are you seeing there? Because we see a lot of headlines, obviously, in the West that say the Chinese economy is on the brink of collapse. Obviously, they had major issues with their real estate market. China is obviously not going to be revealing to the world all of their true economic data. At least we have to assume that there's some things that the CCP is not releasing onto the general public. What are you seeing there? Are these articles we're seeing hyperbole? Do you think the economy really is in that much trouble there? And how do you think they're going to advance when it comes to this trade war? Do you think they will eventually capitulate and come to the table?
Well, to answer the end of your question first, yes, China will cut a deal with the United States. China remains a very weak country in many ways, and it's much smaller than people think. It is a country that has optimized its economy to focus on exports to the exclusion of all else. The one sector where Chinese individuals could play was real estate, and they did. And the government pushed it because it absorbed a lot of labor. But what you see in China, and I read Chinese history as an undergrad at Villanova many years ago with one of the great sinologists of his era, Cornelius Kiley. China is still a village in many respects, and they copy us. They have more debt, more government-sponsored enterprises, than FDR and the New Deal could have ever thought of, right? But the problem is in China is you don't really have a capitalist system the way the United States does. It's an allocation system. Loans are not repaid. So they're constantly having to bail out their banks, bail out their local governments, and then they allocate more currency to them. So at the end of the day, there's no savings here. There's no real building. And many of the things that they do build, cities, buildings, multifamily real estate, et cetera, are excessive. In other words, they don't need it. They have a shrinking population right now because of the one-child policy. So there's a lot of contradictions in China. They always blow themselves up. They always put out these statistics that show them growing, faster than the other industrial economies around the world. I tend to discount those. I tend to not take them on their face and look at the reality. And I think the reality, as you said, is that they have some big challenges.
You brought up some good points earlier about how pervasive the US dollar is when it comes to the global economy. A lot of countries that are dollarized. There's also the euro dollar market, which not a lot of people pay attention to or consider, just a proliferation of US dollars throughout the world and how difficult it is to untangle from that system. What do you make of the narrative out there that the BRICS nations are trying to de-dollarize and that eventually they're going to move to some kind of gold-backed currency when it comes to settle, or gold plus other commodities backed currency when it comes to settling trade between them? Do you give any credence to that, or is that all kind of noise?
I think most of it is political and geopolitical in nature. So, for example, the Ukraine war with Russia. Russia had to find another means of payments. They had to try and get around the U.S. system because the U.S. used sanctions and other blocks to essentially hem them in. Other nations, Korea, there are probably half a dozen or more of the BRICS that really want to try and stay away from the U.S. because of sanctions. Iran, obviously. But I really think that the fundamental problem is these are still barter systems. So, for example, the Chinese set up that payment system with Russia. There are a couple other nations that have tried to use it, but there's no financing available in this system. It's simply an allocation system which says, I sold you X amount of copper, you're going to sell me whatever to balance it off. You don't have the ability to finance the way you do in dollars, in yen, and euros. So I would think that the utility of these agreements are going to be very limited. People use the dollar because they trust America. It's not a matter of economics. It's a matter of privacy for investments, a certain amount of opacity in terms of who comes and goes into the dollar as a means of exchange for trade. So that's really why people use the dollar. It's partly because they can finance so easily in it, partly because there's anonymity and still a high degree of confidentiality in the U.S. economy. And it's these qualitative factors that make the dollar so enduring, not the fact that it's backed by gold. Vladimir Putin could back his currency with gold and commodities tomorrow. But are people going to trust him? No, of course not. Same with the Communist Party in China. It was funny, they sold a lot of gold over the past week in China, and people pointed to this and said, well, they're doing effective asset management. I was kind of surprised that the gold was still there, because the whole reason you're a member of the Communist Party in China is so you could steal stuff and move it offshore. That is big. And 10% of the population in China are party members, remember. So that's how they control things. They want to have a certain amount of buy-in, but at the same time, why are you a party member? So you can live well. That's not a sound basis for a currency.
Let's shift to the banking sector in the United States, because with the speed at which our news cycle moves these days, particularly with social media, the banking failures in 2023 seem to have been mostly forgotten. I wonder what your thoughts are there, because I've spoken to some people who believe they reflected a larger weakness in systemic issues in the overall banking system. Were they that serious? Were they kind of a one-off event that is now under control? Or should we be concerned about the health of the overall banking system in the United States?
They were quite serious. I'm in the midst of rebalancing our index. We actually follow the biggest banks in the U.S. So we index the top 103 this quarter. And yes, they've sold off. They've given back pretty much all of their gains from 2024. But at the same time, if you look at why did Silicon Valley Bank failed, it was probably mostly the Fed. The Fed had moved interest rates too low. They then continued to build their portfolio, reinvest mortgage backs, reinvest treasuries for too long. They could have stopped quantitative easing as soon as bond spreads got back into line, and they didn't, because Janet Yellen, Jerome Powell, Ben Bernanke, these are all progressive Democrats who believe that they should do more rather than less. So what happened? Silicon Valley Bank took their eye off the ball. They were buying mortgage-backed securities. In fact, 40% of their balance sheet was mortgage-backed securities. And they failed. They didn't manage their duration effectively. You have other banks like Bank of America, PNC, Truist, who all have the same problem. In fact, if you look at the industry today, about a little less than 4% is the yield on all mortgage-backed securities held by the industry. We're writing 7% mortgages today. So if you have the portfolio at Bank of America, which has an average yield of about 2.9%, let's see, we're at 2.5 trading this morning, 82 cents on the dollar. Now, there are a lot of banks out there that have serious mark-to-market problems on their balance sheet. There are others that have bit the bullet, like KeyBank, for example, and they restructured. And guess what? Their net interest margin jumped 0.75 of a point. You have banks like Citi, American Express, JP Morgan, who got this right, and they don't have a problem. So there are still a number of banks in the U.S. that are badly managed, that took their eye off the ball in 2020, 21, 22, and that's why you saw those failures. They also had other components, but the real reason Silicon Valley Bank went down is because they were gambling with the balance sheet. So yes, there is still a problem. Is it a systemic problem in the industry? No. And frankly, this year we're still looking for that credit recession in consumers. Hasn't happened yet. We're seeing a little bit in autos, a little bit in credit cards. But if you look at residential mortgages, no. In fact, the loss rates on residential mortgages are so low because of home prices, right? That, it's almost a loss-free, risk-free asset for banks today. On the other hand, if you look at apartment buildings, especially in cities, that's a totally different situation. Banks are taking over 100% loss on loans to multifamily apartment buildings today, on average.
What do you make of President Trump publicly coming out and telling Jerome Powell to lower interest rates, and then also following up with that he wants to get rid of him, giving him a little nickname, as he likes to do, calling him too late? What's going on behind the scenes, you think, that's causing Trump to act this way, and why is this all happening?
Rhetorically, presidents love to jawbone the Fed. I remember, I knew Arthur Burns through my father, and, Richard Nixon was terrible to him. Beat the hell out of him in private. Horrible anti-Semitic slurs, the whole bit. So Trump is basically, talking his book in public. But the reality is most of the data that's coming in does not suggest that the Fed needs to cut rates. I think they're wrong. I think if you look at the carnage on the commercial side, they really probably should back off rates a little bit, because even though, SOFR at 5% or a little under 5 today is not that high historically, but the difference between where we were in 2021 and where we are today is dramatic. And it's causing a lot of problems. Think about this. There are brand new apartment buildings in New York City that are fully let, but that are going to go into restructuring because they can't make it with the debt that they have. We saw way too much debt taken on in 2021 because it was cheap. But now they have to roll it. And guess what? That 2%, 3% loan is going to turn into a 7 or an 8% loan. And so you have a whole class of assets that have to be restructured. Trump is sensitive to this. He knows what's going on. But at the end of the day, the Fed, he's got to be very careful. Let's say he gets, to next year and Jerome Powell is done as chairman, right? Trump would like to appoint his own chairman. He would like Powell to step down. But Powell could stick around. Powell's term as governor goes through 2028. And if Trump isn't careful, I think he's going to see a replay of what happened with Harry Truman when he got into a big fight with Mariner Eccles. This was at the end of World War II. The Fed wanted to regain their freedom from the Treasury. And so Mariner Eccles sat on the board until the end of his term. What that would mean is that if Powell's term comes pretty close to an end, he wouldn't be able to appoint Kevin Warsh. He would have to appoint an existing governor, so probably Mickey Bowman. That's where the politics here are so important. The president cannot fire Jerome Powell, right? The only way to get rid of Powell that way is if Congress impeaches him. But the president can't just tell him to leave.
Let's talk about gold now. Obviously putting in a great performance over the last several years. One of the few assets that held up quite well in the aftermath of the tariff announcements while the rest of the market was melting down. What do you think are the catalysts that have brought us to where we are now? And are we in the early stages of a gold bull market in your view? Or are we overbought here, somewhere in between? What are your thoughts?
Gold, as you know, was essentially killed by Franklin Roosevelt 100 years ago when he seized gold from individuals and also from U.S. banks. Most of the gold sitting in Fort Knox was stolen from the shareholders of U.S. banks with no compensation, by the way. I think gold is coming back because of concerns about the dollar. You see the same driver with cryptocurrencies. But I also think that the big driver for gold in the past 12 months has simply been scarcity. The Russians, the Chinese, both on the governmental level and also individually, have been buying a lot of gold. They're worried about the dollar. They're worried about the United States. So I think that trade is still got a lot of legs. I'm long gold, but I think you have to be cognizant of the fact that there's tension between paper and gold. So if the U.S. markets rally, as I think they're probably going to, gold is probably going to take a little pause here. But I would tell you, I think it's a very good trade to stay long gold going forward because the Congress of the United States is not looking to embrace fiscal discipline anytime soon, quite the opposite. And that, unfortunately, is pretty much typical. People say, well, Chris, when did the U.S. get off the rails? When did they lose the ability to govern themselves? It's always been a problem, going back to the inception of this country. No politician likes to raise taxes. They couldn't even raise taxes to help us fight the British. So, you look at it today, you have a society that's totally spoiled and thinks that they're entitled to be spoiled. And yet, on the other hand, they don't want to pay taxes. So there's a fiscal negative here in the equation that you got to remain cognizant of. But at the same time, I'm long the S&Ps because I know that when the cash comes rushing back in, it's going to, the U.S. equity markets are the inflation hedge. That's what's so unfortunate. The poorest Americans, working Americans, don't have the benefit of that hedge. But if you're an affluent citizen with access to the capital markets, you can make it work. Real estate was a hedge too, but the Fed is kind of, blown that up so much that I think we're going to see a reset in housing by the end of the decade.
That's an interesting take on the broad market there, because I have a lineup down the block of guests on this show who are pounding the table that it's all set to collapse anytime now. We're going to see a massive bear market in all the broad indices. There's a lot of indicators people point to: the Shiller PE ratio, the fact that it's a small handful of tech stocks that appear to be overvalued by a lot of metrics that are holding up a lot of these indices. Give us your take on why are you long the S&P at this point in time?
Because it sold off rather considerably. 2024 was a silly year. My banks were running 50, 60% year over year gains. Banks are not supposed to run that fast. And I understand that some of them are more efficient and better managed than others, but the whole industry ran that way. The average was like 40% in our index. So what I'm saying to you is that people often look for these apocalyptic, very sudden, very 1930-esque kind of collapses, or even 2008. But what they fail to realize is that the Fed, with all of its faults and all of its mistakes that they make rather frequently, at the end of the day, they're going to inflate this thing again. And that's what the markets react to. It's really not the case that people want to run out and go into other currencies. Where are they going to go? When my friends talk about China, for example, selling all their treasury bonds, I look at them and I say, well, okay, we sell the bonds. We're in cash dollars now. What do we do? Do we go out and buy yen? Do we buy copper? What do we do? And the reality is that the world is captured inside a dollar system created by Franklin Roosevelt. And if you don't understand this, then you don't understand how this ultimately is going to work. Now, there are certain markets like private equity that are going to go through a terrible restructuring in the next couple of years. In fact, I expect to see flows coming out of private equity markets going back into public equity because of liquidity. How about that? Now, are the stocks a great deal? No. A lot of these tech stocks are, quite frankly, more vaporware than anything else. But still, compared to what? That's the ultimate question. And I think for many American investors who don't necessarily want to go invest in, real estate in Uruguay or what other alternatives are out there. I have family in Uruguay. That's why I say that. There are limited alternatives. And that's why I expect the markets to go back up. Even banks. The banks are going to be boring this year. They're not going to be nearly as exciting as last year, but they're still going to go back up when managers become more comfortable. It's ultimately the comfort of managers in the equity markets that determines which way this goes.
Are you watching the silver market at all right now? Because when we look at the gold-silver ratio, obviously we're historically stretched. There's a lot of people who do say, however, that silver has become much more of an industrial commodity. It's no longer as recognized as it used to be when it comes to being a monetary metal. However, on the flip side of that, when it comes to precious metals bull markets historically, we do tend to see, not always, but very often, the pattern of silver catching up with and exceeding gold on a percentage gain returns in the latter stages of a precious metals bull market. Well, how are you viewing silver at the moment?
Silver is something that we will always love. Americans going back to the 1800s, when they forced the Treasury to buy silver for a while, almost caused a collapse of the U.S. government before the turn of the century. And I think that there are times when it's an interesting speculative market, but ultimately gold comes first. Silver is a bit of a derivative. So if, we recently saw silver running faster than gold. It caught up quite nicely. And all I say to people is, look, this is largely an industrial commodity now. It has very little monetary value, but this is nothing new. We knew that in 1890. When most countries around the world had stopped using silver for monetary purposes and just said enough, it's for jewelry. So I think I follow gold more than silver. I have taken note of where it is recently. And, it's like I say, it's a secondary metal as far as I'm concerned.
And what about other commodities? Because, interestingly, this goes a little bit against your thesis that we're going to continue to see the broad market perform well up ahead. The counter argument from a lot of people who, obviously it's called commodity culture, so no surprise here. I get a lot of commodity bulls on, but a lot of people believe we're going to see a correction in the broad market. We're going to see a capital rotation event where people are going to rotate from overvalued tech stocks into commodities. Do you give any credence to that? And assuming that the broad market does continue to perform up ahead, could commodities perform well alongside it?
Ultimately, for a lot of commodities like copper, for example, which is extremely important, rare earth metals, I don't think they're going to be affected by what's going on in the economy. They're really more about supply and demand. Even gold. Think about how little gold there is above ground that it's actually deliverable for a large investor. Say you wanted to put $5 or $10 billion in the gold, you would have a hard time getting people to deliver it to you. In fact, in the U.S. right now, we have scarcity on the metals exchanges and other places because people have been taking delivery. You had a lot of short positions that had to be closed out. So for me, most of the industrial metals are a function of the economy. If China slows down, then copper goes down, and vice versa. To me, ultimately, it has to do with economic activity and demand in most cases. Do you want to park your assets in a physical commodity like that? Only if that's your focus. You really have to be very involved in those markets, I think, if you're going to play. For me, as a financial guy, gold is my surrogate. If I want an opposite to the dollar, I was short dollars for most of the beginning of this year. Then I think a long gold, short dollar position is very interesting. But right now, I'm long the SPUs and long gold. I'm going to leave the long gold position because I think it's a medium-term trade.
And what about non-U.S. equities or emerging markets? Because U.S. equities make up 65%, I believe it might be more at this point, of the global equity market. So a lot of people are pointing to that, saying that has to kind of revert to mean at some point. Is there any opportunity out there right now in the non-U.S. equity portion of the market?
There are always opportunities. Central Europe, for example, has been growing much faster than Western Europe. Some of the Asian countries, I think, are also interesting, but they're very small. Even China, the Chinese capital markets are very small. So I tend to focus on the U.S. markets. I sometimes look at European financials if I get demand from our readers. But that's about it. I gave up on the Japanese banks years ago. There's really no reason to follow them. To me, I mostly focus on the U.S. markets right now.
So is the traditional passive investor approach of just buying an index fund and calling it a day, the 60/40 portfolio, get some fixed income, get yourself an S&P index fund, maybe a little bit of emerging markets exposure if you're adventurous. Is that still a valid approach today in your view?
I've always been very cautious about passive strategies. Sometimes ETFs are an efficient way to access certain kinds of exposures. But overall, I pick my own stocks. I mean, if you look at my portfolio, I own bank preferreds. I own some cyclicals just as kind of a backstop. And then I have a couple of techs. I rode NVIDIA up to ridiculous levels, and then I jumped out. So I am an old-fashioned guy. I like to pick my own mistakes, if you know what I mean. ETFs, as you noted in the sell-off in the first 3 months of this year, they just fall. ETFs are biased long. When they go up, they buy more. So when they start going down, they sell more. And the ability of ETFs to crater in a very short period of time is something I worry about a lot for the structure of the markets. You can't have half of the assets in the stock market passive and not eventually have a problem. So, we're waiting. I publish an index. I haven't done an ETF. People keep asking me, Chris, what are you going to do an ETF with the bank index? And right now, I'd rather just let my readers use it for their own asset allocation.
Well, what do you think that sort of event could look like if we do see issues related to the massive amount of passive investing in the markets? Michael Green talks about this a lot. How do you see that the end of the road for passive investing if we continue to see this massive? It's almost like a self-fulfilling prophecy as more and more passive flows come into these index funds, these ETFs. How could this all end? Could it be a catastrophic collapse?
No, you want to look at the ETFs versus the underlying. How big is it? So I'll give you an example. KBWB, which is kind of the surrogate for the banks. It's a tiny ETF. It's only got a few $1 billion in total market cap inside the fund. The totality of bank stocks is much bigger. When you see ETFs start to get to be a significant percentage of the underlying assets, that's when you got to worry. Because, if we have a serious sell-off, just normal desire of investors to pull money out and go to something else, that can have a catalyzing effect on ETFs because they just fall. And the market maker who is sitting there providing liquidity for those creation units issued by the ETF, well, they've got to stand up and provide liquidity. And guess what? If prices are falling, they're going to let their price fall too. So it becomes a self-fulfilling negative cycle for those particular asset classes. And it's something to be concerned about. I think structurally, we've never tested ETFs in a 2008 type of meltdown. We kind of did in 2020 when the Treasury market almost disappeared. But it didn't quite occur as people had predicted. I'm not an end of the world kind of guy. There's too many people who have an interest in keeping this particular poker game going that at the end of the day, I think the managers are all biased long. They don't get paid if they're not long, right? That in and of itself is the biggest conflict we have in the financial markets.
Well, give us some information on your book, Inflated Money, Debt, and the American Dream. I believe the second edition is going to be released this month, if I'm not incorrect there.
That's right.
Give us some details on the book.
Next week.
Great. Where can people find it, and what is it all about?
The book is widely available on Amazon and other sellers. It's my second take on the financial history of the United States. I did the book so that people understand where we are now. How did we get here? How did this sleepy little agrarian society in the 19th century suddenly become the custodian of the global currency? So I thought it was important to come out with the second edition of the book. And, I always look forward to everybody's comments on it. I publish a newsletter called the Institutional Risk Analyst. As I mentioned, we index the top banks in the U.S., and I'm also a consultant to some of the bigger financial institutions in the U.S.
And what's the release date for the book?
It's supposed to be May 6th, so next week.
Okay, great. Well, this episode is going to be up on May 7th, so it should be out by then. So I'll put a link in the description below so people can check it out. I'll put a link to the newsletter as well. Christopher, thank you so much for coming on. It's been a great conversation.
My pleasure, Jesse. Let's do it again.
And thank you for joining us today. This episode is brought to you by ARC, Silver, Gold, Osmium. Take advantage of their specials right now. Silver Kangaroos 2023 1-ounce silver coins, just $2.47 over spot, and Silver Maple Leaf 1-ounce coins, $2.87 over spot, while supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.